Hi everyone, this is Ashish Kyal here. This is another video update on Nifty in follow-up action to the one which we produced about 2 weeks back. Nifty has actually moved exactly that we have expected. We were expecting a bounce back in the form of an ABC wave. The up move ensued in the form of a zigzag Elliott wave pattern. And then we were expecting that the rally should hold on somewhere around 8,400 levels. It did exceed it to the extent of 8445 and retraced exactly 76.4%, and then reversed back from there. There was a very strong sell off yesterday where Nifty closed down by the extent of 250 points negative. I have been analyzing the past data, and surprisingly, a close of 250 points is now was last seen only in October 2008. So this shows the magnitude of the fall on downside, and it has been so sharp that many of the long positions who wanted to unwind probably are still stuck in the market. And if that unwinding starts, then there will be much lower levels that we'll be seeing on Nifty. This video update is about giving the Elliott Wave perspective on the markets, and it's initiated by Wave Strategy Advisors, an independent research company. And what we are going to do is we are going to release such kind of series of video educative series, which will be published probably every week, once every week, and it will explain about the current state of Indian market. So coming back to Nifty, so where we stand right now is Nifty has managed to sustain the gap down opening of yesterday, and today also there was no such buying pressure which emerged at the lower levels, and the overall trading was in sideways range. This helped RSI to relieve to an extent, and at the same time we are expecting that as long as 8,220 level, which should now be used as a trailing stop loss method for short positions, as long as 8,220 is intact, it is better to ride the trend on downside. There can be some supporting activity around 8,050 levels as we saw today, because it's the lower Bollinger Bands area as on the daily chart. So some supporting activity cannot be ruled out from here. But however, the overall major trend looks to have reversed. 8627 looks to be a very important top on upside, and as long as this 8,220 level is intact, it's better to ride the trend on downside, probably for the targets of 7,800, where wave C will be equal to wave A. And if we are right, we are relating this all pattern with a very similar pattern that we saw during the formation of top in November 2010, if I remember correctly. And in January 2011, there was a very clear flat correction pattern which was ongoing, where wave B retraced 76.4%, and then wave C started, which fall almost by 1.618 times of wave A. If that happens, then the lower targets somewhere around 7,400 will open up. However, we will not be very aggressive as of now, and we will use 7,800 as the first target zone. But one should always keep the profits intact, and it is better that as and when we keep falling, one should keep booking the profits either in the form of partial profit booking, or if someone is trading options, then probably lower their strikes to the respective levels. That's one way of trading. And the next way is probably just following the trailing stop loss method, and as long as prices does not close above the previous day high, it is better to stay in the direction of the trend, which is currently down. We have recently published a monthly research report where we highlighted why the fall in crude prices is not necessarily good for the global economy, because it is related to the slowdown in global demand. Manufacturing has not picked up. Crude prices have fallen from somewhere around $108 to sub $50. Now, $40 to $50 is the range where the cost of production for Russia, Saudi, and many of the oil producing companies. So if crude prices fall down further, there can be a chaos in the global economy, and this can result into havoc on the equity markets as well. So it is better to avoid creating any fresh long positions as long as we do not see again the new highs above 8627, which will change the wave structure. And for now, over short to medium term, it is better to stay on the short side, and we think that this downtrend should continue at least till April 2015, where majority of the time cycles are bottoming out. Any minor bounce back or pullback should be used as an exit opportunity for the long positions, and for short positions, keep trailing the stop loss. For any further update on the short-term direction of Nifty on daily basis, you can always visit our website wavestrategy.com or subscribe to our daily research report. Thank you.